Welcome again, everyone, to another session and video on analyzing the finances of some really interesting companies. And this company, AFC Energy, actually has a very similar story to another clean technology company we analyzed called Powerhouse Energy. So we're going to drop a link in the video here. If you haven't had a chance to look at that video on that company, really recommend you do so. This was another company that was submitted by one of our viewers, right? So your voices are being heard, everyone. So if you have a company that you would like us to analyze, whether you are thinking about doing business with them or whether you're thinking about investing in them and you would like our expertise and analysis on their finances, leave a message in the comment section below and we would absolutely do it. So thank you, Astro369G, for your request, and as well as Alex Hunter Warburton, who seconded that. So very interesting story about their finances, which Ted is going to uncover for you. So stick around in this video to find out what that is. Just give you an idea of what AFC Energy do. They essentially develop, manufacture, sell alkaline fuel cell systems, right? And these can be used for a variety of applications, such as industrial, charging kind of electric vehicles, biogas, bioenergy. So this is going to be a really interesting one. And this is not going to be, I have a suspicion, Ted, we're going to be looking at quite a few clean tech businesses now, right?
Right, it certainly sounds it. So you're absolutely right. So we looked at Powerhouse Energy and AFC. This is the AFC, and funnily enough, they both have very, very similar traits, but there's also differences. So if you're looking for a compare and contrast, look at this video and then watch Powerhouse. So let's jump straight into the numbers. Here we go. So here is AFC Energy, their annual report and accounts. It's available on their website to download for free. Just put in AFC Energy annual report and accounts to your Google search engine. Whiz all the way down to page 68, which is where you find the financial statements, and everything that goes before that is all the kind of, you know, the strategy of the company, and aren't we wonderful, and the board of directors, and how wonderful they are, and their board, their Learjets and all that kind of stuff. Okay, so first thing we see for this company, and it's slightly strange that, you know, this is the second company we've done today, and here is revenue. Revenue is zero. And if revenue is zero, the cost of sales is zero, and therefore the gross profit or loss is zero. So these guys are not trading. Now, this is the second company we've seen that are not trading, and you don't normally see this. Imagine downloading, I don't know, Sainsbury's annual report and accounts, or BP's annual report and accounts, or Facebook's, and they just said revenue zero, and you think, oh, I'm not going to be investing in them. Anyway, so these guys are they're not trading, they're not making, and they haven't been either this year or last year. They've got a little bit of other income. So they've got the costs of running the business, 4.6 million, up from 3.6 million. There's a little bit of finance costs coming through, a bit of a tax credit. And so we can see the bottom line is basically a loss. So why are they not booking any revenue? You'd have thought that, you know, if you start making jam on mum's kitchen table, you know, the first thing you do is make a pot of jam, sell it, see if people like it, and then you make 2 pots, etc., etc. So there's something going on here. So we need to look at the notes, and we're going to go and look at their revenue recognition note. So revenue recognition is here on page 73. So let me just find 73. Here it is. And so the revenue recognition says, you know, when are you allowed to book a you know, revenue or a sale? Now, if you're selling pots of jam from mum's kitchen table, it's pretty easy, but unfortunately with the kind of the latest accounting standards, it's a little bit more difficult if you are dealing in contracts. Okay, and effectively what these guys are doing, they're investing in the business. They haven't secured the contracts, or they haven't done enough work under those contracts in order to be able to say, hey, look, you know, this is a sale. Okay, so we look at the revenue recognition, and it just kind of gives us that, you know, effectively they haven't performed any contracts. They've been developing the technology, etc., etc. So, well, we can kind of, you know, we know that if you are, you know, if you're running a company like that, and you know, and you're not making any if you're not making any revenue, then you're going to need a pretty strong balance sheet sitting behind you in order to kind of support you until you get to the stage where you start making money. So this is the kind of the metaphorical equivalent of the person sitting in their mum's kitchen table experimenting with different types of jam. They've got to be able to survive until they get to the time it takes to actually sell that jam. So here are their assets, and where assets are split between their non-current assets and their current assets. Now, the biggest number here by far jumps out at us is this number here, cash. These guys have a lot of cash. Out of 35 million of assets, 31 million is cash sitting in the bank, and it's there, it's waiting. You'll notice it's gone up dramatically from 1.4 million to 31 million. And if you know that if the company isn't making any revenue, the increase in cash must have come from a share issue. So that's reflected in them selling shares and raising lots and lots of cash. So they're sitting on this cash. Let's look at their liabilities down the bottom half of the balance sheet. The balance sheet is displayed a little bit differently to a normal or to most of the balance sheets we've looked at so far. But here are their current liabilities. We can see the current liabilities easily below the current assets because, of course, they've got all that cash sitting in the bank. Here's the non-current liabilities, a little bit of lease liabilities, etc. And here is the equity. Which were, in fact, let me just undo that and put that in blue. So here's the equity. This is the shareholders' investment. And what we really see here is that they've made a loss of 51 million. So they've invested 51 million in developing this product and this technology. And the shareholders have backed them to a tune of 80 million. And so the difference is 30 million, and that 30 million is sitting in the bank. So if we strip away all the little numbers, and they're big numbers, but they're little numbers for this company, they've raised 80 million from shareholders in total. They've spent 50 million, and they've got 30 million left sitting in the bank. They lost 4.5 million in the year. Let me just clear those drawings. They lost 4.5 million. If we go to the cash flow statement, which is a really important one here. So their loss is about 4.5 million. There it is, and their cash burn is, in fact, let me just scroll down a little bit further. So their cash burn is about between 4.3 and 3.3 billion a year. So it's somewhere around here to here. So this is really the number we're looking at. But here we've got a bit of movement in working capital. I'm not going to get into too much detail, but let's say they're burning at 3.3 million. So they got 30 million in the bank. They're burning at 3 million a year. They got about 10 years to get this out. Now, you may remember, Moeed, that we looked at Powerhouse. Powerhouse were burning at about they were losing 1.5 million. They were burning at 800,000, and they had 100,000 in the bank, and they had a shareholder who said, I'll stump up 700,000 if you really need it. This is basically the other end of the spectrum. These are guys, they've got 30 million in the bank. They're burning 3 million a year. They've got 10 million 10 years effectively of burn rate to make sure that they can actually develop, deliver, and prove that this technology is going to work. Not to say it is going to work, but they've got time. Time is on their side, unlike our other guys at Powerhouse. So a few other things I thought I'd highlight while I'm here. We'll just bounce around a little bit. So just looking through some of the numbers I found on 93. There's a lot of share options being issued. So they're issuing share options, and also, in fact, let's just go back to that cash flow again. I wanted to highlight the cash coming in. So here we see the proceeds. Here's the proceeds from the sale of the issue of share capital. So the latest share capital funding was 35 million. So you'll often hear people talk about round A, round B, round C, and what they do is that they raise money, and when they've spent it, they go back to the investors and say, well, we're further down the line, we need some more money, we need some more money, we need some. So rather than getting all the money that they need up front, they have to keep going back and keep the story alive. And hopefully these guys, their story is coming to a conclusion and they're about to start delivering on it. I quite like this company. I thought the mission statement, we just look at page 2. So it kind of sums up what they do. So alkaline fuel cell systems, as you said, the next generation of clean energy, best in class performance, lowest operating costs as part of global efforts to decarbonise the industry. So this is very much a play on the future, on the sort of the eco climate change, clean energy bill. So these guys are, they're right at the forefront clearly of that technology. Few of their highlights, I thought, were sort of things that they're actually up to. Route to market, the first commercial orders, so they're starting to get these commercial orders are starting to come in, so the contracts are there, so hopefully we're going to start to see some revenue coming through pretty soon. And really we kind of what we might do is look for the last bit, which is the post balance sheet, so events after the reporting period. Now this becomes quite important because what we like to see is something that talks about we've secured a contract after the reporting period. There's nothing in there about that, so there's nothing that says that we've managed to secure the contract, that we're home dry. So this is still a play on the future. This is still there's still a lot of risk in this company. I don't know the industry and I don't know the operations well enough to say whether this is a worthwhile investment, but what I do know is that these guys will be around next year and the year after and the year after, unless something very drastic happens, whereas for a Powerhouse, the other company we were looking at, it wasn't so certain. Their future was a little bit more shaky, if that makes sense. So if we then look at the share price of these guys, here's our share price. So they're reasonably recently, in fact, they're not recently listed. They've been around since 2008. Sorry about that. Here's their share price. This is a roller coaster ride. I mean, if you're a day trader and you want to make some money, then these guys are pretty good. And you'll see a couple of spikes in the share price. We've got it. This is it. We're going to the moon type of thing. And then suddenly reality hits and the share price comes all the way back down and it slumps down the bottom. And then suddenly we've got it again. We're going to the moon. And then the share price comes all the way back down, languishes again. So there's a good story in there. And then there's a lot of volatility going on. So this is a very volatile. You're either a day trader and you're setting your stop losses pretty close and riding the momentum, or this is a very long-term hold. There's no pattern in there, there's no momentum. This is all about the potential. Can they deliver? Do you buy into the story? Is it going to happen? Is now the time? We don't know.
Yeah, really interesting. And thank you to our two viewers for asking us to look into this company. This was educational for both of us, actually, to look at this industry a bit more. So what are your thoughts? Yeah, go ahead.
Sorry, let me just finish on this. Just the market cap, 498 million pounds. So you're basically paying 500 million pounds for this company. The net assets, as we said, are 33 million pounds, and that 33 million pounds is basically cash. Okay, so they've got a lot of, they've got the technology, but you're basically buying a company that's got 30 million pounds in the bank, is burning 3 million pounds a year, and you're paying 500 million pounds for it. There's no P ratio because they're not earning anything. It's expensive, but doesn't say it's not a buy.
Yeah, I mean that's pretty much all goodwill, right? So yeah, love to hear what everyone else thinks. And, if you have any other companies that you want us to look into, leave a note in the comment section below. And as always, like, share, subscribe. Ted, this was wonderful as always. Thank you, everyone. Have a great day.
Good to speak to you, Moeed.